The Iran shock is not only a geopolitical event, it is a system event that is the part most people will miss, and it is why many portfolios are not prepared for what may come next. Most investors look at the news and ask the wrong question. They ask whether the headline is good or bad. They ask whether oil is up today or down today. They ask whether the market will fall this week or recover next week. Those are not the right questions. The better question is this: what chain reaction does this create, and which assets are fragile inside that chain reaction? When oil rises, it does not stay in the oil market. It moves through transportation, it moves through production, it moves through food, it moves through consumer prices, it moves through corporate margins. It moves through interest rate expectations, it moves through the choices made by households, businesses, central banks, and investors. That is why I say this calmly but directly. The shock is coming for portfolios that are built as if the world is still simple. If you are not prepared, you may be part of the group that reacts emotionally, sells into weakness, buys the wrong things too late, and misses the opportunity that chaos always creates. But there is another group of investors. It is a smaller group. They do not celebrate chaos, because chaos hurts real people, but they understand it. They prepare before it arrives. They know that when a system breaks, good assets and bad assets often get sold together at first. They know that fear compresses prices. They know that a crash is not the end of investing. It is often the place where the next decade's wealth is created. That is the way I want you to think about this. Do not click around looking for a magic answer. Do not smash buttons. Do not buy something because you are afraid of missing out. Do not sell something because a red headline made your stomach tighten. Just slow down and understand the mechanism. Right now, oil prices are rising. When oil prices rise, the economy receives a different kind of pressure than it receives from a normal growth slowdown. Oil is not just another commodity, it is an input into almost everything. When the cost of energy rises, the cost of moving things rises, the cost of producing things rises, the cost of heating, cooling, manufacturing, shipping, and operating rises. And when those costs rise, businesses try to pass them through to consumers. That brings inflation pressure back into the system, and when inflation pressure returns, the central bank has less freedom. That is the trap. If the economy weakens in a clean way, the Federal Reserve can usually cut interest rates to support demand. But if the economy weakens while inflation is rising because oil is pushing costs higher, the Fed faces a much harder problem: cut rates. And inflation can get worse, keep rates high, and the economy can weaken more. That combination is what people fear when they use the word stagflation: high inflation and weak growth at the same time. That is the scenario that scares investors because it attacks both sides of the system. Consumers are squeezed by higher prices, businesses are squeezed by higher costs, weak companies lose access to easy financing. The middle class feels pressure, small businesses with weak balance sheets get tested, companies without fortitude get exposed. It is survival of the fittest. That may sound harsh, but markets are harsh when the cycle turns. The weak are forced to sell, shrink, merge, or disappear. The strong survive. And after the storm, the strong often become much stronger because competitors are gone, assets are cheaper, talent is available, and capital flows toward the survivors. That is why a crash does not scare a serious long-term investor in the same way it scares a reactive investor. The reactive investor sees only the fall. The serious investor asks what survives. This pattern has repeated for more than a century. The reason changes every time. One year it is inflation, another year it is a pandemic, another year it is a mortgage crisis, another year it is a technology bubble, another year it is war, another year it is energy. The story changes, but the market cycle repeats. There is an expansion, there is excess, there is a shock, there is fear, there is selling. Then there is repair, repricing, and a new advance led by the companies that survived and adapted. The name of the crisis is not the most important variable. The quality of what you own is. This is why I do not believe a crash itself destroys a good portfolio. What destroys portfolios is leverage, bad behavior, inflation, impatience, and owning weak assets that cannot survive the cycle. If you own a fragile company and the cycle turns, you may not recover. If you own a strong company and the cycle turns, the price may fall, but the business can continue compounding on the other side. That difference is everything. You want to be buying when there is blood in the streets. But that sentence is often misunderstood. It does not mean you buy anything that has fallen. It does not mean you buy junk because it is down 70%. It does not mean you buy oil just because oil is rising. It means you prepare a rational shopping list before fear arrives. You identify the companies that should matter more over the next 10 years, not just the next 10 weeks. Then, when the market gives you weakness, you buy slowly, carefully, and according to a system that is the opportunity. Not panic buying, not headline chasing, not hiding in cash forever. A disciplined long-term shopping list. Now let us understand the foundation. When oil spikes, macro conditions deteriorate because costs rise, inflation pressure rises, the Fed has less room to cut, consumers spend less on discretionary things. Weak businesses lose margin. Companies that depend on cheap capital or smooth supply chains become vulnerable. That part is not complicated. It is the basic cause and effect. But the next step is where investors separate themselves. Many people hear oil shock and immediately think buy oil. That is too simple. Oil can go up for a while, maybe 3 months, maybe 6 months, maybe a year, but oil is cyclical. It has always moved in cycles. It can go from low levels to very high levels and then back down again. If you are a trader, maybe you want that. But if your goal is to build a portfolio for the next 10, 15, or 20 years, chasing a cyclical commodity is not the whole answer. I am not saying oil cannot work. I am saying it is not the same as owning long. Duration compounding assets tied to the most important structural trends in the economy going fully to cash is also not a real long-term answer. Cash feels safe during a crash. It gives emotional comfort, but over decades, inflation attacks cash relentlessly. If you sit in cash for too long because you are afraid of volatility, you may avoid one kind of pain while accepting another kind of loss. That loss is purchasing power, and purchasing power loss is quiet. It does not show up as a red number on a brokerage screen. It shows up when everything you need costs more and your dollars buy less. Defense contractors may do well in certain geopolitical shocks. Defensive sectors like healthcare, consumer staples, and telecom may help in periods of fear. But those are not automatically the best strategy for a full decade either. They can protect, but they may not create the kind of long-term compounding you are looking for, so the question becomes simpler and more important. What are the strong businesses that could be pulled down by fear, but are still positioned to matter much more in the next decade? That is where the opportunity is. Think about Amazon during earlier crashes. It was not a smooth ride. It was hit hard. It looked dangerous. It looked expensive at the wrong moments and broken at other moments. But it survived, adapted, and compounded because the business was aligned with major structural changes in the economy. Survival was the key. Not because the stock price never fell, because the company lived through the fall and became more important afterward. That is the principle I want to keep in the center of your mind. A great company that survives a crash can become a generational wealth creator. A weak company that looks cheap in a crash can become a permanent loss. The difference is not the price drop. The difference is business quality, balance sheet strength, relevance, margins, and the ability to benefit from the world that comes after the shock. So when I think about the current environment, I do not begin with the headline. I begin with the needs of the system. What will the world need more of? Even if oil prices rise, even if inflation pressure returns, even if geopolitics become more chaotic. It will need reliable power, it will need AI infrastructure, it will need memory, it will need semiconductor production, it will need decision systems that work under uncertainty, it will need cybersecurity, it will need automation and productivity, it will need companies that help the world function better when the world becomes harder to manage. That is the logic. Now take AI as the center of the long-term trend. AI is not just software. AI is a physical infrastructure demand machine. It needs chips. It needs memory, it needs data centers, it needs cooling, it needs electricity, it needs networks, it needs cloud systems, it needs cybersecurity, it needs databases, it needs tools that allow governments and businesses to make better decisions in chaotic conditions. That means the AI supercycle is not one company and not one stock. It is an ecosystem. And when a shock hits the market, the best parts of that ecosystem may become available at better prices. The first category I think about is energy that compounds with technology, not just oil. Energy that helps solve the power problem for AI and modern infrastructure. AI data centers consume enormous amounts of power. If the grid cannot keep up, the bottleneck becomes electricity, cooling, and localized power systems. That is why companies tied to nuclear, cooling, and on-site power production become more important. There are companies that fit into this sleeve because they help AI function in a power-constrained world. Constellation Energy is tied to nuclear power. Vertiv is tied to cooling and data center infrastructure. Bloom Energy is tied to on-site power production that is less dependent on the grid. The specific tickers matter less than the principle behind them. If AI demand continues rising, power becomes a strategic input, and when energy prices become volatile because of geopolitical pressure, companies that help solve reliable power problems can become more valuable, not less. That is the kind of energy exposure I prefer for a long-term portfolio, not simply chasing the spot price of oil, owning parts of the infrastructure that the next economy needs. The next category is memory. Most people talk about GPUs because GPUs became the visible bottleneck, but as AI systems become more complex, the need for memory rises dramatically. Agents, super agents, longer context windows, more complex tasks, and larger systems require more memory. If the complexity of what we ask AI to do increases by a large amount, the memory need increases with it. The market for memory is highly concentrated. A small number of companies control most of the supply. Building new production is not instant. It takes time, capital, planning, and execution. That means if demand rises faster than supply, the companies already positioned in memory can benefit. Micron is the US-centric way to express that idea in this framework. The point is not that every price move will be smooth. It will not be. A stock can fall significantly and still fit a long-term thesis if the business is tied to a powerful structural bottleneck. That is difficult for many investors emotionally. They think if a stock is down, the thesis must be wrong. Sometimes that is true, but sometimes the price is down because the market is fearful, cyclical, impatient, or repricing risk broadly. The job is to understand whether the business remains aligned with the long-term need in memory. The long-term need is clear in the source logic. AI needs high bandwidth memory, and the supply chain is not easily expanded overnight. The next category is production. The world cannot build the AI future without production capacity. NVIDIA and AMD address the GPU side of the bottleneck. ASML is tied to lithography, the machines that make advanced semiconductor manufacturing possible. TSMC builds the actual semiconductors at scale. ARM and Cadence are on the design and software side. Amphenol participates in connectivity. This is the production sleeve. It matters in normal times. It matters even more in chaotic times. When geopolitics become unstable, supply chains matter more. When AI demand rises, semiconductors matter more. When countries and companies want resilience, production and design infrastructure matter more. That is why I do not want to be distracted by every headline. I want to own the companies that sit inside the bottlenecks. Bottlenecks are where value often concentrates. If everyone needs something and only a few companies can provide it, the economics can become powerful. That does not mean you buy at any price. Price matters, position sizing matters, patience matters, but the category itself is important. Then there is the category of decision making in chaos. When the world becomes more uncertain, businesses and governments need tools to understand what is happening, where risk is building, and how to respond. That is where Palantir sits in this framework. It is not just a software company in the way people casually use that phrase. In the original logic of the source, it is a company that helps organizations make decisions when the environment is chaotic. That matters when supply chains are unstable. It matters when governments are under pressure. It matters when companies need to understand complex data. It matters when defense, energy, logistics, finance, and operations all become harder to manage. CrowdStrike fits into the related idea of cybersecurity. In chaotic times, cyber risk does not go down. It usually goes up. The more digital the economy becomes, the more exposed it becomes. Security becomes mission critical. Datadog and MongoDB fit into visibility, monitoring, and database infrastructure. Oracle, Microsoft, Google, and Amazon all participate in cloud data and enterprise systems. Again, the point is not to memorize a list. The point is to understand the principle. When the world becomes harder to operate, companies that help organizations see, decide, secure, and execute become more important. That is why chaos can actually increase the strategic value of certain businesses. The next category is automation and real-world productivity. If energy is more expensive, labor is more expensive, capital is more expensive, and uncertainty is higher, then productivity matters more. Companies that help the world do more with less become more valuable. Tesla fits this category through robotics and autonomous driving in the source logic. Meta fits through advertising efficiency and platform scale. Amazon fits because it combines AWS retail data, logistics, and automation. SoFi fits as a financial platform. Robinhood can also fit into a modern financial access and platform framework. These companies are not identical, but they share an idea. They help create efficiency, scale, access, automation, or productivity in a more difficult world. And in a more difficult world, efficiency is not optional. It becomes survival. Now, after laying out these categories, the most important thing is not to confuse a stock list with a strategy. A list of good companies is not enough. Having the right companies without the right system still leaves you vulnerable. Many investors know the names, they still fail because they buy too fast, buy too large, use leverage, panic during drawdowns, or run out of cash before the best opportunities arrive. That is why the buying system matters. I believe in buying slowly, dollar cost. Averaging is not exciting, it does not feel heroic. It will not make you look like a genius on the exact bottom day, but it prevents a serious investor from trying to predict the bottom, which is one of the most dangerous games in investing. You do not know where the bottom is. I do not know where the bottom is. No one knows the market can fall and then fall again. A shock can last longer than expected. A recession can deepen. Inflation can persist. A central bank can stay tight longer than people expect. Sentiment can remain bad for months. If you spend all your cash at the first sign of weakness, you lose the ability to act when prices become even better. That is why patience is a form of capital. Cash has a role, not as a permanent hiding place, but as dry powder. It allows you to buy slowly through fear. It allows you to stay rational when other people are forced to sell. But there is another part of the system that matters. You need a core for many investors. That core is the S&P 500. People often overestimate their ability to beat the index with individual stocks. They chase stories, concentrate too heavily, and then discover that the index was the discipline they needed. A core position gives stability. Individual companies can create upside. The combination can be powerful if built rationally. Do not use margin. Do not borrow to buy. Do not take debt because you think you are smarter than the cycle. Leverage is what turns volatility into destruction. A great company can fall 40% and recover. A leveraged investor can be wiped out before the recovery arrives. That is why I would rather be slower, calmer, and alive on the other side. Never panic buy. Never buy because social media says this is the last chance. Never assume the first drop is the final drop. Build the position over time. Let the market give you opportunities. Do not demand that it gives you the perfect one. The companies I want to own in this kind of environment have certain traits. They are not only related to energy, they thrive in chaos. They provide certainty or stability when uncertainty rises. They are mission critical in ways that are hard to undercut. They are best in class or close to it in their category. They have fundamentals that can support the long-term story. This is where many people make a mistake. They become obsessed with the narrative and ignore the numbers. A good story is not enough. The business has to show revenue growth, margin strength, operating improvement, and a path to durable profitability. In the long run, stock prices follow business results. Not perfectly, not daily, not monthly, sometimes not even yearly, but over time, revenues, margins, earnings, cash flows, and competitive position matter more than the noise. Look at the way people argued about Palantir. Some focused on valuation, some focused on insider selling. Some said it had too much government exposure, others said it did not have enough. Some said competition was coming, some said it was not truly AI, the noise was endless, but the long-term question was simpler. Were revenues developing? Were margins improving? Was the company becoming more important to customers? Was operating leverage showing up? Was the business moving in the right direction? If the answer was yes and continued to be yes, the market eventually had to respond. That is a principle you can apply across the list for a memory company. Watch demand, revenue, free cash flow, and the AI-related product mix. For a power infrastructure company, watch backlog, data center exposure margins, and the durability of demand. For a production bottleneck company, watch the strength of the monopoly or near monopoly position, pricing power, and customer dependency. For a cybersecurity company, watch retention, growth, platform expansion, and margin progression. For an automation or productivity company, watch whether the company is actually improving the economics of customers and expanding its own margins. The stock price is the output, the business is the engine during crises. People stare at the output and forget the engine. That is why they make emotional decisions. They sell a great engine because the output is temporarily ugly. They buy a broken engine because the output once looked exciting. A serious investor reverses that. Study the engine. Now think about the market over long periods. There are always red periods. Bear markets happen, crashes happen, wars happen, pandemics happen, banking crises happen, inflation shocks happen, recessions happen. But bull markets have historically been longer and more powerful than bear markets. That does not mean every company wins. It means that productive businesses over time grow revenues and profits, and the market reflects that growth. If you can hold through fear, avoid leverage, own quality, and add intelligently when prices are lower, the cycle becomes your ally. If you panic, chase, borrow, and buy weak assets, the cycle becomes your enemy. The same external event can create wealth for one person and damage for another. The difference is preparation and behavior. That is why I am not stressed in the way most people become stressed when they hear about a coming shock. I take it seriously. I do not ignore it. I do not assume everything will be fine in a straight line. But I also do not treat volatility as a reason to abandon long-term principles. There will always be reasons to sell. There will always be headlines that make you think this time is different. The world does not stop. Companies continue to build. Consumers continue to need services. Governments continue to spend. Technology continues to advance. The best businesses continue to improve. Even when their stock prices temporarily decline, the market is a weighing machine over long periods, but it is a voting machine in the short term. In moments of shock, the voting machine becomes emotional. That is when disciplined investors get paid for being rational. The coming environment may be difficult. Oil pressure can create inflation pressure. Inflation pressure can limit the Fed. Limited Fed flexibility can increase recession risk. Recession risk can create selling. Selling can drag down strong and weak companies together. That is the chain, but the next chain matters too. Selling creates lower prices. Lower prices create opportunities. Opportunities allow patient investors to buy quality. Quality survives. Survivors compound. Compounding creates wealth. Both chains exist. Most people only see the first one. The investor's job is to prepare for the second one. So I do not want a portfolio that simply reacts to Iran, oil, or any single headline. I want a portfolio built around the systems that the world will need after the headline fades. Reliable power, AI infrastructure, memory, semiconductor production, decision-making systems, cybersecurity, cloud, data and monitoring, automation and productivity, a strong index core, no leverage, slow buying, a system for adding, a focus on fundamentals. That is how I think about the last big wealth opportunity of a decade. Not as a single moment, not as a perfect bottom, not as one stock tip, as a process. You build the list before fear, the categories before panic, you decide position sizing before headlines, you keep cash available, you buy slowly, you focus on companies that matter, you track business results. You ignore noise that does not affect long-term fundamentals. That is the playbook. The biggest danger now is not only that the market falls. The bigger danger is that investors behave badly when it falls. They sell quality because they cannot tolerate red numbers. They chase oil after the move is already obvious. They hide in cash and then miss the recovery. They buy speculative names without balance sheets. They use margin because they want to get rich quickly. They confuse volatility with permanent impairment. Those behaviors destroy portfolios. A crash does not have to. In fact, if you are prepared, the same crash that frightens others can give you access to companies you wanted to own anyway, but at prices you could not get during optimism. That is the paradox of investing. The best opportunities rarely feel good when they arrive. They come wrapped in fear, uncertainty, and discomfort. If it felt easy, everyone would do it, and the opportunity would be gone. The goal is not to become emotionless. Human beings have emotions. The goal is to build principles that can operate even when emotions rise. My principles are simple. Do not chase the headline. Understand the cause and effect. Own what the world will need. Buy strength when fear misprices it. Use a system. Avoid leverage. Keep a core. Watch fundamentals. Be patient. Survive. Survival is underrated because people want speed, but in investing, survival gives you the ability to compound. If you survive the bear market with capital, courage, and clarity, you can act when others cannot. That is how wealth is created across cycles. Not by predicting every turn, by being prepared for the turns you cannot predict. The Iran shock may become one of those moments. Maybe it arrives fast, maybe it unfolds slowly, maybe oil spikes more, maybe the market overreacts, maybe the Fed gets trapped, maybe the economy weakens. I do not need to know every detail in advance. I need to know the structure. Higher oil can create inflation pressure. Inflation pressure can constrain policy. Constrained policy can hurt weak businesses. Weakness can create market fear. Market fear can lower the prices of strong companies. Strong companies that survive can compound on the other side. That is enough to prepare. If you wait until the fear is obvious, you will not be thinking clearly. You will be trying to make decisions under pressure. That is when people make mistakes. The right time to build the shopping list is before the store goes on sale. The right time to define your rules is before the red candles appear. The right time to decide that you will not use margin is before you are tempted. The right time to accept that you cannot time the bottom is before the market starts falling. Preparation comes before opportunity. That is true in markets. It is true in business. It is true in life. The people who make the most out of chaos are not the people who love chaos. They are the people who understand that chaos reveals who had a system and who is improvising. Most investors are improvising. They follow the news, they follow the crowd, they follow whatever stock moved yesterday. They follow fear on the way down and greed on the way up. That is not investing, that is being moved by the environment. A serious investor does the opposite. He studies the environment, then decides how to position for it. In this environment, I do not want fragile assets that only work when money is cheap and the world is calm. I want businesses connected to necessity. Power is necessity. AI infrastructure is necessity. Memory is necessity. Semiconductor production is necessity. Cybersecurity is necessity. Decision systems are necessity. Productivity is necessity. Those are the places I want to study, not because every company in those areas is good, but because the direction of demand is aligned with the future economy. Then I want to ask which companies inside those areas have the strongest positioning, strongest margins, strongest growth, strongest execution, and best ability to survive a shock. That is where the real work begins. And when the market gives me fear, I do not need to invent a thesis on the spot. I already have one. That is the difference between reacting and investing. So as this shock develops, I want you to remember the main point. The headline is not the whole story. Oil is not the whole story. The crash is not the whole story. The story is the transfer of opportunity from the unprepared to the prepared. In every major market break, wealth moves. It moves away from people who used leverage, chased hype, held weak businesses, and panicked at the bottom. It moves toward people who had cash, patience, quality assets, and a system for buying when fear was high. That is not luck. That is structure. And if you understand the structure, you do not need to be fearless. You just need to be disciplined. When oil rises and inflation returns, do not let the first order effect blind you. Look at the second order and third order effects. Who gets hurt? Who survives? Who becomes more important? Who has pricing power? Who has mission, critical products? Who is tied to a bottleneck? Who will still matter in 10 years? Who can improve margins through the cycle? Who can turn chaos into demand? Those are the questions. That is where the opportunity is. The next decade will not reward people who simply own random risk. It will reward people who own the right kind of productive risk. There is a difference. Random risk is buying whatever is down. Productive risk is owning strong businesses tied to structural demand with the patience and sizing to hold through volatility. Random risk feels exciting. Productive risk compounds. That is what I want. I do not want to be clever for 3 months. I want to be positioned for 10 years. I do not want to chase oil because oil is moving. I want to own the infrastructure, technology, and mission critical systems that the economy will need regardless of whether this month's oil chart is up or down. I do not want to run from every crash. I want to use the crash to buy what I already wanted to own. I do not want to predict every headline. I want to understand the cause and effect chain well enough to act rationally when other people cannot. That is the entire idea. The Iran shock may be coming, the oil pressure may be coming, the inflation pressure may be coming, the market weakness may be coming, but opportunity may be coming with it. And if you prepare correctly, the next period of fear may become one of the most important buying windows of the decade. Not because everything will be easy, because the best investments rarely begin when everything looks easy. They begin when the system is under pressure, the weak are being exposed, the strong are being mispriced, and disciplined investors have the patience to buy slowly while the crowd is panicking. That is how I would approach it. Calmly, rationally, with a shopping list, with a system, with no leverage, with a core portfolio, with dry powder, with attention to revenues, margins, and business quality, and with the understanding that history is not a perfect map, but it does rhyme. The reason changes. The cycle repeats. The prepared investor survives it, studies it, and uses it. The unprepared investor is used by it,